What's going on? This is David W. Williams, also known as Diamond Dave, the founder of the highest paid part-time job in the world options trading program. And what we're going to do is a real quick case study on how we got 103% return on investment on Kodak put options, right? And so this is going to be a really basic breakdown of a put option. And what we want to do different with this is not just show you the actual trade that I made, but give you some justification behind the trade so you can kind of understand our thought process going into the trade. So what makes us different than a lot of these people that are showing their options trades is they just showing you what they did. They showing you the beginning, they showing you the end, they showing you the results. We're going to kind of go behind the scenes and kind of give you some context as to what we're thinking about when we go into a trade. And what another thing that makes us different is that we don't do a lot of technical analysis. This particular trade is really based on fundamental analysis, right? So let's go ahead and get into it. So everybody knows about Kodak and the big increase they had in share price a few years ago, right? Based on them supposedly getting floated a loan. And so then once people heard about them getting that loan, a lot of people rushed into Kodak and rushed into this particular ticker. And so we're going to kind of go into that story and how we were able to generate a good amount of income, right, in a short amount of time just with put options. So here's some examples of the trades we made. So go ahead and give you some transparency about what we did. Here goes some more examples of the trades that we made. So let's go ahead and get into it. So question is, how do we do this, right? So we talked about before. We're not going to just show you what we did and how much money we made. We're going to kind of break it down. And because we're not technical analysis guys 100%, we're going to kind of go into the fundamental analysis, right? Because to me, as an options trader, you got to understand technical and fundamental. You can't just be a purely technical guy, right? Especially with these type of situations. You can see it coming a mile away once you understand the fundamentals. So here is a 2-year right chart for Eastman Kodak, right? So if we look at the 2-year chart, we see that their share price was between, I want to say, $245, $250, and maybe $5 for around a year. I'm sorry, for around 2 years, right? So from November, let's say 2019, let's just say from 2019, it was around $250, $260, and it pretty much traded within the $250, $245 to maybe $5 range until late July of 2020, right? So that is essentially their chart for all my technical people. Now what we're seeing is a shorter chart going out over the past 3 months where we're seeing it trading in a really tight range and it jumping up to around, I want to say, a little over $35 to $40, and it's starting to come back down. So what I'm looking at is a situation where this chart was trading around $2 to $3 for almost a year. So when I hear about the fact that Kodak is going to get a loan, right, from the federal government, and they're going to manufacture pharmaceuticals, when I'm looking at this, because I heard about that early, right? I heard about it before everybody else. But when I looked at their chart, my question was, why were they trading in such a really narrow channel that was under $5 for almost 2 years? What is the reason behind that? And, they're putting out earnings reports, things of that nature. News is coming out about this company, but there's still no demand on their shares, right? So that's the first question. So I have to be able to explain, why is this taking place? Then the question is, how likely is it that the loan will go through? Because what we found out is that they really got a letter of intent for a loan, right? They never actually got awarded a loan. They got awarded a letter of intent, which saying that the government intends, right, is the key word, intends on allowing them access to a loan as long as they can meet certain requirements. That was the actual scenario going on. Then the third thing is, what is the time span for this company to turn around? So let's say they do get the loan, best case scenario, right? And then they're able to manufacture pharmaceuticals. What is the time span from them, one, to get the loan? How long is that going to take? Then two, once they get the loan and they start going into pharmaceutical ingredient manufacturing, how long is it going to take for them to get up to speed in that area? And then how long is it going to take for them to get the relationships to where those particular ingredients are going to go to specific companies? So there's going to be a timetable and milestones attached to all of these three things from a business standpoint. So the question is, what is it going to take for this situation to turn around where the market will no longer value these shares at $2 to $5? So these are the questions I would ask before I would get excited about news that they got awarded a loan, right? So seeing that those questions were never really answered by either Kodak when I saw them interview the CEO. He really wasn't able to answer these questions. The media had no information. I was bearish, right, on the fact that it jumped up. So once I saw it jump up, in my opinion, this thing is going to go down as fast as it came up, right? Because what most people did is they came in with the impression it's going to keep going up. When it doesn't keep going up, and when that volume starts to evaporate, what people are going to do is they're going to leave it as they see it selling off. They're going to be more inclined to sell. So that's what I believe was going to happen. And what do we see happen? 729, we see the jump up, right? And it settled around, let's say, $33, $34 it closed. 730, it came out, it popped up almost to around $42, $43. And what did it do all 730? It started to walk its way down. So what we're seeing is that it was seeing it falling down a cliff on 730. Then what do we do on 731? It continued to fall down a cliff. All right, we had the weekend, 8.3, it comes out, it keeps falling down, it keeps declining. We see it declining some more in 8.4, and then around 8.5, it started to trade horizontal. So what we saw was that after you had the big spike to around $50, $55, it started to come down, right? Went back up again to another high of around $45, and it started to come down, and it started hitting what we call lower highs and higher lows, which really means that it's a declining slope. And this is what I anticipated, is that once buyers realized that the share price was not going to continue to go up, and they only bought it because they felt like it was going to go up, they're going to leave. And so when I saw the behavior of it on, I want to say Thursday, I bought my first put contract on that Friday. I may have bought it on that Thursday, and then I think I bought another one on that Friday. And then I bought some more the next week, because my belief was that this thing is going to continue to sell off and continue to sell off and continue to sell off, because like I said before, is that there was a reason why this particular company traded between $2.50 and $5 for almost 2 years straight. There's a reason for that. And them just coming out with news about a loan doesn't change the fundamentals inside that particular company, right? And so if the market really believed that this particular company was worth $40 or $45 or $50 a share, as it sold off, what would they have done? They would have bought more shares. But because they really didn't believe it, once it started to sell off, then they also decided to exit. They were not in for the long haul. And I think if you look at Kodak right now, it's probably around $5. Yeah, it is. It's around $5.56. So the questions you want to ask before, right, you buy the puts is, how much of a fall do you forecast? So when you're looking at this thing starting to fall, where do you think it's going to start falling at? And that can be based on your technical analysis, but really their lowest support was $2. So from a technical analysis standpoint, their support was $2. So from a technical analysis standpoint, I should anticipate this falling back down to $2, because that's really where their historic support is at, right? How long will the fall take? So how fast do I think people are going to leave this? What strike should I take as an options trader, right? What strike should I take? So when I buy in, let's say it's $35, do I go really close to the money because I know it's falling, so I'm going to already be in profit? Or do I look for cheaper premiums by going a little bit farther out, right? What expiration dates do I take? Goes back to, again, as how long do I think the fall is going to take? How fast do I think this situation is going to continue to decline? So what expiration dates do I need to look for? So these are the questions that I ask myself before I buy the put contracts. So we go back again. We see Thursday, July 30th, Friday, July 31st. So I bought a 30, bought a 25. Then I bought a 15 and I bought a 12.50, right? And for the 15 and the 12.50, we could have had a lot more return on premium if we could have gotten this situation to fall faster. Like I said before, as it started to trade horizontal, and a lot of that stagnation, it killed the volatility, right? And so that was one of the challenges that we had, right? It didn't fall. Once it got under, I want to say $20, it didn't fall as fast as I anticipated. I thought that once it got under 20, it was going to free fall back down to $5 to $2, but it didn't do that. It started trading horizontal in the teens. So some takeaways is this. Could I have purchased bigger positions on higher strikes? So instead of me purchasing the 15 and the 12.50, should I purchase 2 of the 25 and then 2 of the 30, right? And then just got out there, and as it continued to fall, just benefit from the premiums, right? And maybe that could make my premiums go higher, even though I wasn't getting the free fall that I desired. It would have been worth it to extend my expiration date. So would I benefited more from having my expirations go out maybe till October or November? And then I wouldn't have had to worry about how fast it's falling because I would have had such future expiration dates, right? And that could have benefited me more because right now it's at $5. I set those plays up to be out within like 1 to 2 weeks. And so because I wanted to go ahead and get in and get out because I thought this was going to fall apart essentially as pretty much as fast as it ran back up. So I didn't want to tie my capital up and pay the premium for the expiration or the more time by buying farther out. So those are two takeaways in which I maybe could have improved this situation a little bit better. And so as an options trader, you always, when you exit, want to analyze and say, what could I have done to make this situation better and more profitable for me, operating in this particular scenario. So what we want to do is kind of show you a breakdown of how we buy put contracts. A lot of people know how to profit from a market going up. They really don't understand how to profit from a market going down, especially if it's not a day trading situation. A lot of guys can buy puts over, especially the technical guys, they can buy puts over an inter-day session. When you start talking about going out multiple days and multiple weeks, I think that's something that's going to be a lot more suitable for somebody that has a background and is very well rooted in fundamental analysis, because you have to understand why your company is going to continue to fall apart over time. And some companies, as they start to fall apart over time, they accelerate, right? And a lot of times you can't see that because technical analysis is more historical, and a lot of times fundamental analysis is more forecasting, right? And we also understand that the market doesn't have to be up for us to make money. So one of the benefits of being an options trader, right, is that you can make money on both sides of the ledger. You don't just have to make money from the appreciation in the stock price. If you want to learn how to do this, and you want some of the benefits of having the ability to generate this kind of income, not have to sell your time to your employer, not have to steal time away from your family, but not have to worry about that you're going to lose income because you're not involved in these things, reach out to me about the highest paid part-time job in the world. It's a really, really thorough options trading course. I got the Discord group also popping off. This is David W. Williams, also known as Diamond Dave. If you got any questions, hit me up. Talk to you later.